Welcome to the Daily Update, where I'll go over the action in the market for Thursday, July 27th, and then we'll see how things look for Friday, July 28th. We had a fairly significant down day. Actually, on the intraday chart, it looks a little more scary because we gapped higher to the upside, and I have to confess, I was watching the futures before the market opened, and they kept going up and up and up because Europe was having a good day, and I thought, okay, if there's going to be a downward move, it's probably going to be today, because we really haven't been gapping all that much. And the market seems to be taking it for granted that we're positive now. And so when we saw a gap higher, I thought, okay, first we'll go back and fill the gap. Then it's really pretty likely that we're going to keep going lower. And that's exactly what we did. Let's go back and talk about what happened. Right at the open, we did gap above R2 at 4,600, which that's another round level. That's another level that's now acting as overhead resistance. We went a little bit above that. We hit resistance at, I think it was 46.07 before falling down to R1 at 45.84. As the day went on, prices rose back almost to R2 before falling down to R1. Then we fell below the unchanged level, then the daily pivot at 45.66, S1 at 45.49, and then we found support at S2 at 45.31. Prices closed near the lows and just slightly above R2. Really, we weren't down all that much on a percentage basis. It was down 0.64%, but volume was above average. You saw a lot of people suddenly scurrying back to take care of things. The technicals were still positive, believe it or not, and we're doing a good job of working off this overbought situation. We're getting into that moment of truth now with a big inflation report coming out on Friday. So if the market acts positively to that, okay, we've worked off a lot of this overbought situation, and now maybe we can go back up. If we see follow-through weakness, because we're also coming into a weak part of the month, then that could turn things more negative. But for right now, we're still hanging in there. And it's all about inflation and interest rates. What are some comments that we can make? There was a Nikkei report, that's out of Japan. They're going to discuss possible changes to its yield curve control policy. This produced some concerns and a possible unwinding of some carry trades that have been supportive for U.S. asset prices. When I do the weekly video and I talk about all the different interest rates and I say, yeah, Japan's this red line and it's still really low and they have their own little story going on, this is part of that story. They own an awful lot of U.S. bonds. And if they get to the point where they're going to have to start selling those bonds, well, when you sell bonds, that pushes interest rates up. And that could really put some pressure on the U.S. bond market. And then that can in turn put pressure on the stock market. Bonds did fall hard on this news. The 10-year bond went back above 4%, and that's what started to push stocks down. The European Central Bank did raise rates 25 basis points, but there's some speculation that they could also be close to finishing raising their interest rates. We're also keeping this question in the back of our mind. Will this positive scenario continue? That we'll be able to have a soft landing, that the Fed is almost done raising rates, and that earnings in the future will stay positive. On a short-term basis, our list has become a lot shorter. We just have the stochastics chart now. Intermediate term, the PMO studies, the Sean Trend Meter, and the BPI, both for the S&P 500 as well as the NASDAQ 100. Long term, it takes longer for those moving averages to move, so we're still looking a little extreme even though they turned down. The dollar was up and interest rates were also up. All of the yield curves that we follow still remain inverted. We're still extreme positive. We ticked down to 78 where we had been at 80, and then this closing price before was 77. Our trend is still positive. The ADX is still above the moving average. The green line's still on top, but it is declining. We're above the moving average. We're coming down from that 40 level. So we still default to the positive until we see things turn back more negative. The bias now is negative with the down day, and I've switched our momentum to mixed to positive. What are the economic reports that came out? We had weekly jobless claims. They continue to fall more than people are expecting. They had expected it to be down 233,000. They were down 221,000. Continuing jobless claims also declined to 1.69 million. The advanced GDP report for the second quarter, this was the big one. It came in at 2.4%. That's initially what gave the market some strength. They had expected it to be at 1.6%. Last time it came out at 2%. The GDP price deflator was at 2.2%. Last time it was at 4.1%. So this is also suggesting that inflation is coming down. Durable goods orders were up 4.7% month over month. They expected it to be up 1%. Last time it was up 2%. If you take out transportation, we were up 0.6% month over month, more than the 0.2% they had expected. Last time it was up 0.7%. The advanced international trade in goods deficit, it was at $87.1 billion. Last time it was at $91.1 billion. Advanced retail inventories were up 0.7%, and advanced wholesale inventories were down 0.3%. Here's some charts to show you. Here's the real GDP, which is the blue line, showing that we're still above zero. The deflator is actually coming down. That's more of an inflation gauge. Then we look at personal consumption, which is still above zero, but it is declining. The net exports are flattening out a little bit. The real GDP, this is the big one. Real means you're taking inflation into account. We are seeing an advance in GDP, at least with this initial report. Durable goods orders, also, after coming down to zero, have been showing some improvement. And non-defense capital goods orders, when you take out aircraft, it's declining, but it's still above zero. When we look at durable goods on a month-over-month basis, maybe there's an economic recovery of sorts starting to happen. Weekly jobless claims continue to decline, suggesting the job market remains strong. Continuing claims are also declining. And when we look at all of them together, we had the unemployment rate a while back. That's the black line. The red line are the initial claims. That's declining. And the continuing claims are also declining. This is giving the Fed justification to continue raising interest rates and also suggesting that we may not head into a recession. Looking at the pending home sales, we did decline, but we are showing some improvement. Some IsabelNet.com blog charts. Here's the first one. This is the deviation above the 50-period daily moving average. And we have charts that kind of mimic this same thing. It's just showing that we're getting kind of far away from that 50-period moving average right now. This acts like a rubber band. If we get too far away, it has a tendency to pull price back. Looking at the economic surprise index, this is interesting. The U.S. is actually holding up better. That's the black line. The Eurozone is seeing things a lot weaker. When their economic reports come out, they are tending to be weaker than expected. Looking at gold, this is just interesting. The spot price is what is gold right now. We're looking out down the road. Those are futures contracts, and just showing how we're still running into some overhead resistance with gold. This is comparing gold to the US dollar, which I cover in the intermarket analysis video, and another look at gold to the US dollar. Then the S&P 500, which is on the top, the percentage of stocks above their 10-day moving average. I usually don't watch this all that close. It's starting to deviate a little bit, where we're making higher highs with the S&P, but we're seeing a negative divergence when we look at the number of 10-day moving averages that are also going up. Then the sentiment indicator still suggesting that folks are still exuberant, and I have a number of charts to back that up. Then Bank of America, which ones on the Fed are voting and how do they vote? I'm not going to go through this. If you want to pause this and just see their names and where they're from and see if they're hawkish or more dovish, feel free to look at that. Then looking at outflow of investment grade bonds, we're seeing folks starting to take money out. These are bond funds. These are more conservative funds. These are funds that folks like to get into for longer periods of time, and they're generally in competition with the high yield bonds, which we often refer to as junk bonds. Then the earnings revision breadth has turned lower recently, now negative once again. So when we're looking at all these earnings together, they're starting to come down a bit, and that can put some pressure on the market. What's the debt allocation? We're now right at 21%. We had been a little higher. That means folks owning bonds, it is continuing to decrease. Tom McClellan had some interesting charts. He likes to do a lot of this shifting forward and matching up different patterns. He's looking at the Dow, which is on the top, and then the 10 to 1 year spread shifted forward 22 months. And he's seeing some correlation here, that when we hit a bottom in the yield spread, that's when we also hit a bottom in the market. But we're wondering, when are we going to hit a bottom with this spread? Because it keeps going down and down. He also had another chart comparing unemployment rate with the 10 to 1 year spread. When this spread starts to go back up, that's quite often when we start to see the unemployment rate going up. But this spread continues to fall. Getting into our charts and analysis, here's the intraday chart where we really gapped up above R2. We came down to R1, almost made it back up to R2. Then this is when the weakness came in. We came down. The first drop looked like we were possibly filling the gap. Well, we fell below that. We came down below the unchanged level, the daily pivot. Down below S1, we made it all the way down to S2 and then bounced a little bit up off of S2 going into the close. Here's the intraday chart, also not looking all that pretty. The futures are looking a little bit better in the initial overnight session. And then large cap growth and value, they were both down on the day. But growth was down a little bit less for the large caps. It also was down less for the mid caps as well as the small caps. Looking at the growth to value ratio, it actually held up a little bit better. We're above the dashed line, so it was positive even though it went down with everything else. Keeping an eye on sentiment, the Ulcer Index is pretty much flat. There's still not a lot of fear going on here. The VIX did turn up a little bit with the line chart as well as the bar chart. And the VIX of the VIX, now we're seeing a pickup in volatility as the VIX starts to move. Keeping an eye on the VIX to S&P 500 correlation, this is still coming down. We're wondering if that's feeding into some of this downward movement that we're seeing. Also looking at the 5-period equity put call ratio, it ticked down just a little bit. That's kind of a surprise. When this is going down, that tends to be more positive, but we're still wondering, have we bottomed and are we going to keep going up overall? And then here's a longer term look at that same chart, showing how we could be starting to bounce back up. Longer term though, we still look positive. Looking at the MOVE index, it really didn't change all that much. For as much as bonds moved, it ticked down a little bit. The VIX was up a little bit. We're seeing them having a tendency to go in opposite directions as the correlation between the two weakens. We had the latest reading of the American Association of Individual Investors. Well, things a week ago were a little bit more negative, so they're not quite as positive as they were before. We also keep an eye on this red line. This is a moving average of how they're feeling longer term, and it's still continuing to show some improvement, but still below zero. Then looking at this other fear gauge, we did tick up on this chart, where we continue to tick down on this other chart. We're seeing a little bit of a recovery with our ratio between the risk on and risk off after it had been down a couple of days. Looking at our advanced decline line, we did turn down based on price, rolling over a little bit based on volume, but still hanging in there. The new highs, because we had that gap higher, we did set a bunch of new highs, so that hasn't really affected this much. We are a little bit concerned that we're seeing this dropping off a little bit. Our 5-period is rolling over a bit, but is still positive. However, our 10-period is starting to decline. The advanced decline ratio did decline, but is still above zero. Accumulation distribution, we're dropping further below the moving average. That's a warning sign of what the smart money is doing. They may be starting to sell into strength. We saw a little bit of weakness here with the cumulative NYSE advanced decline line, where it really fell back down. The regular advanced decline line also fell. And with the other NYSE advanced decline line, we did fall, but we're still well above this upward sloping trend line. Looking at common stock, we fell based on price. We also fell based on volume. We're seeing more strength looking at price, where we're still showing this negative divergence based on volume. Looking at our advanced decline line studies, they all fell across the board, but still remain above their moving averages. Looking at our trend, the ADX continues to go up and is now getting above 40. The green line's on top, but it is declining. Our shorter term ADX, also the green line is declining, but the ADX continues to show strength. Volume did pick up a little bit, but continues to be below average when you take it in total. Our short-term chart, we came up to the underside of this trend line, and now we're starting to come back down. Will this other pivot level hold if we see more weakness? On the bottom, you can see where volume did pick up to above average. We're still okay with our 20-period double and triple exponential moving averages, but we're starting to drop below them. We're also keeping an eye on the regular 20-period simple and exponential moving average. We're still above both of these. If we continue to fall, will they provide support? Back in June and in July, they did provide support. We'll see if that ends up happening this time. Our stochastics, we're no longer extreme in the short term. We're turning down and still extreme in the intermediate term, rolling over and still extreme in the long term. The force index did decline, but is still above zero. Our intermediate term trend charts, we did decline, but we're still above the dashed line with the balance of power. We're coming down to the blue double exponential 50-period moving average. Will this offer some kind of support? It has been doing that recently. We'll see if it holds up again. The go-no-go system is switching back more to neutral with the lighter shade of blue bars. We're dropping down from the highest high level, but we have not come down to the midpoint, at least yet. The TTM squeeze showing a little bit of weakness where we're seeing a darker colored blue bar and a bit of a decline with the overall oscillator. The Erin indicator really didn't show any change. We're still showing the buyers are in control and that sellers are decreasing, so our oscillator continues to advance. Looking at the S&P 500 McClellan oscillator, we've now dropped below zero. That's negative. So our summation index based on price is starting to turn down. We're also turning down based on volume. We want to keep an eye on this. This could suggest things might switch more negative in the intermediate term. Looking at the NYSE McClellan oscillator, we also dropped below zero. We're still seeing a bit of improvement here based on price and volume, where price is actually lagging behind volume, where we were trying to break out. We're not confirming that with the price version of this chart. The Swenlin trading oscillator has been declining based on price and volume, but are still above zero. The PMO starting to roll over a little bit. Based on price, we're rolling over. Based on volume, we're rolling over, but they're still positive for right now. The percent of PMOs that are rising continues to decline. The buy signals are declining. We're rolling over and still extreme positive with the PMOs that are above zero. The Elder Impulse system, even with the down day that we saw, it still remains neutral. The parabolic SAR still remains positive. The slope indicator is now starting to turn more negative, and the MACD is a little bit below its moving average, so that's turning more negative. Looking at all of our different oscillators, we're starting to look more negative in the short and intermediate term. We haven't really shown much of a change yet in our longer term oscillators. The Sean trend meter did decline, but it's still extreme positive. The BPI ticked down a little bit, but also still extreme positive. The NYSE bullish percent index is rolling over a little bit, but still is showing some strength. The Chaikin money flow is still above zero, but it is declining. The Chaikin oscillator started to resume its downward slope, so this is negative. The money flow index still above 50, but declining. Ultimate oscillator has now dropped below 50. The vortex is turning back down, but the green line is still on top. The on-balance volume still well above the moving average, even though it did decline. The RSI, we're no longer extreme with the 14 and 9 period RSI. We're wondering, is this going to be another shorter-term negative divergence? Looking at the percent of stocks above their 200-day moving average, it rolled down a little bit, and we're showing a little bit more weakness when we look at our 50-period moving average. The Copic curve, even though it's rolling over a bit, continues to generate a buy signal, and the Pring bottom fisher just generated a recent buy signal. Our Fibonacci and line charts, we're coming up to that August 1st date. Are we going to see some kind of a shift right around this time? It doesn't mean it has to start right on that day. We're just looking at that window of time. Our different charts, the Heikin Ashi still looks positive. The Kagi chart is still pointing up and is positive. The Renko continues to be positive, and the 3-line break is still positive. Our different indexes, we saw some weakness in the equal weight as well as the S&P 500. We saw a little bit of a tick up in the ratio. That's suggesting more broad participation. And then when we look at Dow theory, we finally had a losing day for the Dow. It's turning down. The transports also turned down, and the utilities were also down. Looking at the ratio between the transports and the S&P, this continues to go up, even though it ticked down just a little bit. We're going up overall in this ratio. That's still making things look more positive. And the transports and the Dow are pretty much performing about the same, with the transports starting to outperform slightly. Keeping an eye on the discretionary and staples equal weight study, we actually were pretty much flat with discretionary. We declined with the staples, so our ratio was pretty much the same, but discretionary continues to outperform staples. The Dow did finally see a losing day, but is still above this pivot level. The Dow is still neutral with the Elder's Impulse system. The NASDAQ also dropping down below this pivot level. There's another pivot level that'll be coming up for August. Will that end up providing some kind of support? We're keeping an eye on the 61.8% retracement level. We're still above it, but if we continue to fall, we'll want to be watching that. The cumulative new highs and new lows for the NASDAQ are turning up just slightly, but continue to be weak overall. We're still above zero when we subtract the new highs and the new lows. The NASDAQ 100 also started up strong, ended up finishing weak just about on this pivot level. Can we stay above the August 2022 highs? The Elder Impulse system for the Qs remains neutral. We're also ticking back up because we had that gap higher. Some new BPI signals were generated, so that's showing a little bit of improvement. We're also seeing this longer-term negative divergence with the NASDAQ 100, where we were making higher highs. The PPO was making a lower high and still continues to be negative. Small caps came down but are still above this pivot level. The Elder Impulse system for the small caps remains neutral. And we came up almost to this resistance level with the Russell 2000 index, and then that's when we started to fall. We're dropping, but still above 50 with the RSI. The MACD is showing some weakness, but hasn't quite crossed over yet negative. Small caps to the S&P. Small caps actually outperformed slightly, but have been underperforming in the longer term. Small cap growth versus value, we took a bit of a hit, and we're starting to chop more or less sideways and seeing some more weakness, even though we're still in an overall uptrend. The mid-caps broke down below this pivot level. The mid-caps have been hanging in there about the best. Well, the fact that they dropped below this could be more negative. However, the Elder's Impulse system for the mid-caps still remains at neutral. The mid-cap growth to value saw a little bit of a tick up here. We're still in an overall uptrend. The dollar index was up on the day, getting above 101. The FANG index has still not been able to get back to this previous all-time high. It gapped higher and then spent the rest of the day coming back down. Even though we had a bit of a down day, our ratio ticked down a bit, but stocks are still continuing to outperform 3 to 7 year bonds, suggesting that the market thinks anyway that we will see a soft landing. The banks, after seeing some good up days, had a down day. The financial sector was also down. We're getting closer and seeing if we can generate a golden cross. The financials to S&P 500 did decline and continue to be in an overall decline. The regional banking ETF did spike up a little bit compared to the financial sector, but is still showing longer-term weakness. Keeping an eye on bonds, we saw the 10-year really spike up and close back above 4%. That pushed prices down. We had been above the 200-day moving average. Now we've fallen below it. The RSI is below 50 and declining. The MACD is starting to roll over negative. Watching the Qs to the longer-term bond ETF, we're seeing them having more of a tendency to go in the same direction. Looking at the value to growth ratio, typically we've been seeing them go in the same general direction. We're seeing them now starting to split off and go in opposite directions. Looking at the S&P to the long-term bond ETF, seeing a little bit of improvement with our longer-term relationship and a bit of a tick up with our shorter-term relationship, but the spread between the two, even though it declined, is still really wide. Folks are still favoring more risky bonds over conservative bonds. We're still keeping an eye on this. This is a bit of a concern. We're seeing this ratio going back up when we compare cash to the 3-month bond ETF. We want to see this going down. Our long-term charts, the special case still remains positive on the daily chart, still negative on the weekly chart, but showing improvement. We're rolling over a little bit with our longer-term moving average study. The 150 and 200 did decline, but they're still looking rather extreme positive. Our longer-term weekly chart, looking at resistance, even with the down day, we're still above this resistance line. We're wondering if that level will hold. Also saying about the same thing with the NASDAQ 100. We're still slightly above this resistance line. When we compare the NASDAQ 100 to the Dow and take a ratio of that, we are coming down a little bit with this ratio. We could go back and go higher, but if we start to fall from here, that's what's happened in the past and has usually signaled some negative things for the market. Our possible positive scenarios, seeing this a little bit more weak. The Qs are underperforming the S&P. Discretionary is underperforming the S&P. Large cap growth is underperforming large cap value. Our growth to value ratio, seeing some weakness in the large caps, mid caps, and the small caps. We're still positive when we look at the broad range of the 5-period moving average of the highs minus the lows. And we're still camped out at this higher level with our 10-day average of the S&P 500 high minus the lows. So far, this has been holding up. When we look at the 50-period exponential moving average of the new highs minus the new lows, we're still advancing. Our indicator is still positive and the red line continues to advance. The growth to value ratio declined a little bit. Even though we're still in an uptrend, we've been chopping pretty much down with this ratio In a good solid environment, we want to see this ratio going up. The Staples to S&P 500 ratio ticked down just slightly and has been declining overall. That could come back and give more support to the S&P unless we see this ratio really start to turn and go back up. So our outlook for Friday, there will be a policy meeting for the Bank of Japan. Actually, they've already met, and that's going to be worked into the market by the time it opens. There will be some influential earnings reports that will be released. That's on a stock-by-stock basis. The technicals are still positive, and right now it looks like we're working off being overbought. We're going to have to see, where do we go from here? If we see a lot more follow-through downside action, that's going to switch things more negative. We'll be getting personal income and spending, as well as the PCE and PCE core prices on Friday. That's the big one. We're getting final consumer sentiment, and then I'm a little out of order. We'll get the employment cost index that will be released. We're keeping an eye on the geopolitical events, but again, as usual, the market is fixated on inflation and interest rates. Here's the updated economic calendar for the week. And for the Stock Traders Almanac, we're kind of seeing some differences here. Remember, we're the week after options expiration, which is 50-50, whether it's up or down. The Dow tends to be negative. The S&P is neutral to positive, where the NASDAQ ends up being positive historically. Now we will be on the 19th trading day of the month, where we typically will see some weakness going into the end of July. Also keeping an eye on the NASDAQ, seeing some weakness going into the end of July. Here's the chart for August, and I'll be including this in the videos for next week, just seeing how August typically will start out kind of negative. Then we see a little bit of a bounce back up as the month goes on, then a little bit more weakness, and then some strength going into the end of August. There was a tweet put up by Jeffrey Hirsch, who runs the Almanac Trader. He says August can be challenging in pre-election years. Going back to 1950, August rankings improve modestly. The S&P is number 9 as far as the ranking on the scale, going back to 1979. Here's the look at the chart overall for August, where we have a little bit of weakness. Then we might see some strength back in the middle of the month. Then we tend to see some more strength going into the end of the month. And then pre-election year, August, going back to 1950 with the S&P, we average 0.4% being up. We're up 9 times and down 9 times, so that's 50-50. Our scenarios, can't really go with the down one yet because we're just working off being overbought. Now, if we see more follow-through downside action, that might change, but we're not really seeing a confirmation of that yet in our charts. It's hard to go with the up one unless we have a good solid up day, but we are still positive in the background. The ADX is still suggesting that we're in a trending environment and it's still looking rather extreme. It's positive, but the green line is declining. So our warning signs, we're wondering if this convergence of short-term bearish signals, are they finally coming together? The S&P to VIX ratio, the 5-period moving average of the put-call ratio, the negative divergences that we're seeing with the NASDAQ 100 and that we're coming into a weaker part of the month. The longer-term signals may be signaling a top. So far, they're not. We're still above that on the S&P and the NASDAQ 100 on that weekly chart. We're coming into a weaker historical and seasonal time of the month. The oscillators are turning negative, specifically the NASDAQ 100. The VIX is still showing it's not a lot of fear, even though it did tick up in Thursday's session. The cumulative new highs and new lows continue to show weakness. We're still above the 3-month yield set back in 2007, and we're still going up even from there. The S&P 500 growth is weakening, even though it's still in an uptrend. And then we're dealing with earnings season. Positive signs. We have seasonality and setups that remain in the background. The daily special K chart is positive. The weekly chart, although it's improving, is still negative. The long-term equity put-call ratio is positive. The S&P is still above that downtrend channel upper line. We're still far away from that. The risk-on posture is still continuing and showed a little bit of improvement on Thursday. We're wondering if we continue to fall, will these price levels below where we're at right now provide support? So far, they've been doing that. The S&P is outperforming utilities. The NASDAQ and NASDAQ 100, they're still above overhead resistance, but longer term, they're looking okay. On a shorter term daily chart, we're still having trouble getting above those pivot points. The Staples to S&P 500 ratio is declining. The Russell 2000 and the small caps as well as the mid caps have generated recent golden crosses. Small and mid cap growth continues to be positive. The Copic curve and the Pring bottom fisher have generated recent buy signals. So our conclusion, the S&P remains positive for right now, and it's just working off being overbought. If we see more selling, it could develop into more than that. On a short-term basis, positive, and we are showing some weakness there. Where intermediate term, it looks like we're just working off this overbought situation so far, where we still remain positive in the long term. Thank you. Have a really good day. I hope this was helpful, and I will talk to you in the next video.